Hey, what's up? Trader Tim from EminiMind here doing a trade recap video. It's August 1st, 2024. Nice big down day today after, gapping up right to the 50% retracement short. Fed meeting yesterday, and kind of like we were talking about on Tuesday, expecting a bit of a rally into the close, which we got, and was hoping that we would get a sell-off today on Thursday, so that our puts could have a chance to take another leg lower, and we did, which was nice. As most of you know who've watched these videos, I always like to handle handle swing trade positions at the close, but I did want to talk about one caveat here that I'll be doing tomorrow, and we'll also get into the intraday trades from today. Didn't really have much. The beginning of the week is usually a little bit slower coming into the Fed meeting weeks. I have been seeing lately, we've got a lot of usually these last Fed meetings. What I've been seeing is a sell-off into the Fed meeting, and that's exactly what we got here in the few days leading up to the meeting. So I always try to buy puts, a week or sometimes 10 days out ahead of the Fed meeting to try and catch that move down. So the puts that I bought were on the 23rd, and then we got lucky with a gap down the very next day. So sold half of them to lock in some gains, and then held the remaining half. I did, I'm holding or I'm hedging the Fed meeting. So I want to get through the Fed meeting announcement. The expiration on those were or are next Monday. So not so 1, 2, 3, 4 days from now. And so I wanted to get through today and see if we could close down, which we did. And so I sold all but 2 contracts. So I've got 2 contracts left, and my intention with those is I'm going to close them out at the open tomorrow. And the reason being that we are getting very close to expiration. So if we do get a gap down on the open, I'll just ring the register on those last 2 and call it a day. If we don't gap, or if we gap up, I'll just take them off at the close, just so that I don't have to, or sorry, take them off at the open so that I don't have to sit around and wait till the close to dump them with only, one more trading day till expiration. So most of the time I'm managing them at the close, but since I've pretty much dumped the entire position already and taken profit there, these last 2 I'm going to take off at the open tomorrow morning. And a couple interesting things to talk about from today. So if we look at our gap, our unfilled gap chart here, we came right to the unfilled gap from the 23rd this morning. And when we rallied to that point, that's when the sell-off ensued. And look where we came to the unfilled gap 5444 from the 30th. So these unfilled gaps that we have from just a few days or a week prior do come into play. So it's very helpful to have these gaps up here. I just keep a separate tab or drawing set that I call gaps in Thinkorswim, and then I can save these, and then I can easily switch to a different chart with other markup on it, and I still have the gap saved. I used to use a post-it note, and it got to be many post-it notes for after a while. So it's a nice little Thinkorswim trick there. Let's go intraday. I guess before we do that, well, intraday speak, but just touch on the 15-minute. Monday, we had a stop out right off the open. So Monday would have been the 29th, stopped out to the upside, but then got a move to the downside for 20 points. And our ranges have been bigger. So we're going to be working with bigger numbers here. First 15-minute bar on Monday was 15 points, so only netted 4 3/4 points on the the net of that those 2 trades. Tuesday got the 20 points to the downside fairly quickly. Wednesday was the Fed meeting, so no trading there. And then today we broke to the upside, got taken out, and then got a quick 20 points to the downside. What I wanted to highlight about today is that since the first 15-minute bar is larger than 20 points, in those situations, I take the range of the candle, cut it in half, and then that becomes my stop. So I just rounded up. So the candle itself was 23.5 points. I rounded up to 24 and then divided it by 2. So that gave me a 12-point stop from 23 or from 57.7650 was the entry long, and then subtracted 12 points and made that my stop. So took a minus 12 on the first little break to the upside, which we unfortunately only broke up by a couple of ticks and then rolled over. And so then to the downside, again, got a quick 20 points, but in order to get that, had to see the loss on the upside. So only netted about 8 points there. What I will say this year, interesting with the 15-minute, the second break has been very, very profitable compared to the initial break. The last 2 or 3 years, it was not that way. We'll see what the rest of the year brings, but just something interesting, an interesting observation that I've had so far this year. All right, now let's look at 1 minute and halfway back setups. First trade was early in the day, 6:36, 6 minutes in. We gapped up, small gap up, and then pulled back right to this 50%. You could, kind of draw a 50% like that off of this first little hammer. That one was pretty big, but this was a nice one. 5 green bars, and then a pullback right to the 50%. The hammer body is right about the 50%, so that was a great long entry. 3.5 point candle, so it's within our 4 point kind of criteria, and long above the high, stop below the low. Let these first couple of candles, move up and then pull back. We were early enough in the day. You did get this kind of inverted hammer here, and sometimes on a Monday, I'll get a little more aggressive with my stop on the first trade, just to kind of get the ball rolling and kind of get a winner under my belt. I know that's not necessarily the best habit, but it does kind of help me get things going during the week. But today being Thursday after the Fed meeting, I'm kind of expecting things to be there to be more opportunities. And so for that reason, I didn't feel the need to, I was willing to risk the full 3.5 points because I figured, well, there's probably going to be some more opportunities. Whereas sometimes on a Monday, you might only get 1 or 2 setups, and I kind of like to, get a winner under my belt on Monday. And so sometimes that means I take a smaller profit just to kind of get the ball rolling. So this one, I let it kind of go up these first 2 candles, pulled back, and then once this green candle here broke to the upside, once this one, we broke above this candle's high, then when we took out the swing high here, that's when I brought my stop underneath the swing low. And then we got 4 candles in a row. So this was the first green candle, second, third, fourth. And once we traded that 4th green candle and it closed, I just put my stop underneath that candle's low. And then this is, you love seeing this. Big green candle. The very next candle breaks that prior candle's high. So your stop is initially down here with a big body candle. And that candle was like, how big was that candle? That one was 6.25 points. So when we got that candle, my stop, is underneath that candle when we close, and then the next candle breaks its high. So as soon as this little spinning top candle closes, you can put your stop below that candle. This one I did end up reversing. It's kind of just in I guess a little bit of a trigger happy mood today, and we got this inverted hammer here, and so I put my stop below that candle. You can zoom in here, below that candle, and then I doubled it up so that when it took me out of the long trade, I ended up getting short. Let's see, I thought I had a note about the I guess one thing I wanted to point out on this green run up, even though this green candle wasn't a completely new high on that candle itself, for the 4-bar trail stop method that I use, I consider that the first green bar, and then the second green bar, third green bar, fourth green bar, and once that 4th bar closes, then I'll put my stop below that candle's low. Each of these 4 candles made a new high in themselves from the first green bar. So this one went higher than the prior one. That's the second green bar. This candle was higher than this prior candle's high. Same thing for the next one. So that's where the 4 green bars come from. It doesn't, the first bar does not have to make a brand new high on the day or on the trade. So that's the first one. Then the short here below the inverted hammer within our 4 points. This one was a little bit slow to get going. We traded down. We bounced. Traded down below this candle's low. So I moved my stop just a couple of ticks down. 1 tick above that inverted hammer's high. We traded up again and sold off, broke this candle's low, and then this next bar was a nice big red bar. Next candle closed, and then I had my stop above this candle, not necessarily because it was 4 red bars. You did have 3 red bars, and then this hammer has a tail that goes below this inverted hammer, but because we were at the full halfway back of the day. And so that was like this. And so we came to the halfway back long, right at the 21 EMA. So that's when I want to get my stop a little bit more aggressive here. And so I put it above there. That one only netted 4 points. These candles are getting kind of big here, so it was still a 4-point trade. And then kind of switched gears and had a halfway back long, which was once we broke the opposing long. So that one set up here, broke the short right here with the poke above the 61.8. And so then I just drew up the long like this. We were getting a little close to the top of the hour, but still had 5 minutes, so I was good with that. And then got a nice clean run all the way to the negative 23. I drew it up. I drew the next retracement like that, hoping we could hold it and bounce. But we didn't. So only ended up with 1.25 points on that one. I put my stop underneath this 61.8. I would have gone ahead and take the crossover of this full halfway back, which would have been like this, but it traded right at the top of the hour. This whole push of the crossover was at the top of the hour, so we had some news coming out. So didn't end up taking that. That was really it. A little bit later in the morning, we broke the low of the day, so that took me out of the 15-minute long, but then the short triggered, and it was only like 5 minutes after the top of the hour, and so we started going down. I did not take this hammer here because it was larger than 4 points. And then we started getting tick divergences where the NYSE tick made a low tick at lows just briefly. Let's see, we're at 707. So here's 707. We made a low tick at lows, and then we rolled over, made a new low price, and then continued making new lows after we had made these low ticks. So when we start getting a low price after we have a low tick at lows, you don't want to try buying lows because we're just going into a downtrend environment. And so since the 15-minute opening range breakout triggered, and I was short at that point, I didn't end up taking any short entries in the after we broke the bottom of the 30-minute range, which also happened to be the 15-minute low. This retracement short was totally fine. It lines up below. Well, I say that it was pretty okay. The things they had going for it was below the 30-minute low. We did have this little double bottom, which we didn't have a low tick off of that, but it was a double bottom. The 30-minute low is going to tend to act as some strong resistance. And since we already had the tick divergence, meaning we were making lower lows after the NYSE low tick at lows had already been broken, that kind of weakens the double bottom. So if I wasn't short the 15-minute, I probably would have gone ahead and taken that one. Even the next one, you start to see these trends, and it's just low or low, low or high, and you can take these retracements, especially if we're kind of close to the 30-minute low. This one over here, I didn't like as much because we had a higher low. See how this low, or I guess we'll phrase it this way, the low here is higher than the prior low. So I like that this guy makes a lower low as it relates to the prior low. So that gives you, more of a trending environment. So I try to stay out of this kind of trade when you're getting, a higher low put in, and then you could end up going into like a triangle, or even just holding that 30-minute low, even though it broke by a couple of points, you could trade back into it fairly quickly. So being a little bit patient with that entry and trying to buy the retracement to the 30-minute low is usually a good play. Other notes, the tick divergence, 15-minute. I think that's everything I got for you. Tuesday we were in the room. We were chatting about the different prop firms. You've probably heard me talk about Top Step, and the other one that people had been chatting about is Apex. Those are kind of the big two. I use Thinkorswim and just trade my own money, have for years. But I did reach out to Apex, and they sent me a link for a discount for their platform. The benefit to Apex, after like looking into it and talking with other traders, is you can have 20 accounts, whereas with Top Step you can only have 5. Maybe that'll change down the road. But if you want to just trade 1 or 2 contracts and then have the trades mirrored to all your other accounts or copied over to all your other accounts, Apex does allow you to do more accounts. So I'll put that link below. Otherwise, hope you have a great weekend. And if you have questions, you can either drop them in the comments or over in Discord. And if you like these videos, give it a thumbs up. Thanks. We'll chat soon.